Welcome to retirement planning. You know, I hear from accountants all the time that they don't know how to discuss things like this with their clients to get them excited about doing tax planning. Sometimes they just take the information and run, declining to pay you for a tax plan. So for that reason, I'm going to explain this strategy just how I'd explain it to my clients to give you some ideas. The bottom line is be honest, be energetic, and be excited about the tax savings, and they will be too. Now, I have to tell you, retirement planning is an area that has a lot to be improved with the tax accounting side. Most small business owners tell me that their business is their retirement, and I get it. The amount of money you can make from your business is typically far greater than what you could get in the stock market. However, making money and selling your business are two different things, especially if you're a solopreneur. It's really a toss of the coin whether you're going to be able to sell. Not only that, but you don't know by how much. It's really hard to sell a small private business for what you probably think it's worth. I'd say the majority of businesses just close their doors at some point. As a tax professional, this is where we can be of assistance to our clients to really analyze the situation, help them prepare for that nest egg they're going to depend on at a future date, and reduce tax in the process. So there's a better way. You can funnel significantly more capital into a retirement program than the average person with a job. And that's because the rules here are so much better for you. But that doesn't mean it's best to just automatically sink money into a retirement fund for the benefit today. And there's ways to make money and put it into a variety of assets. You can put it into retirement accounts, which we're absolutely going to talk about, but you could also just put it into savings accounts that are earmarked for retirements. You can also invest in things like insurance, real estate, alternatives like crypto, if you're into that. It's whatever you believe in. There's a way to get all of that and tax strategies and reduction for you now, meaning you can turbocharge your retirement and frankly, make a government pension plan look silly in comparison. Now let's go back to what's right and optimal for a client. Oftentimes, I see accountants make this mistake where they're focused right now on last year's taxes and what can we do about fixing last year. Unfortunately, we're really limited once the year is over. We simply can't change history. And so a retirement plan sort of becomes like a Hail Mary. Let's sink some money into the retirement plan, and that way we can get the tax bill lower today. But if you're going to be in a higher tax bracket in the future than you are right now, aren't you just trading a low tax rate in for a higher one? So I want you to remember that when you make a deposit to a retirement account, this represents a deferral only. It's not a permanent tax reduction. You've got to have a plan for it to come out in a tax-advantaged way, just as you would having a plan to deposit it and take the write-off. First, let's talk about retirement plan options. These are the basics. Now, oftentimes tax accountants don't know how to choose what's optimal for their clients. So I'm going to be going over these briefly and show you what I like and what I don't like, and more about how to discern what's going to be best for your client. So first, let's talk about IRAs. In a traditional IRA, very easy. The contributions, of course, are tax deductible. Again, that means we get lower taxes now and we will pay that tax in the future. So make sure you have a plan on how to reduce that tax as well. We are limited with a traditional IRA to what the IRS has prescribed as the maximum that can be deducted. In this case, it's $6,500 or $7,500 if you're over the age of 50. You are taxed on that distribution once you retire, and so long as you're older than 59 and a half, you won't get what's called an early withdrawal penalty. Now, required minimum distributions, and this is new, are required at age 72. There are limitations on this traditional IRA. You might not even be eligible to deduct the $6,500 when you have access to an employer 401k plan, for example, and have high taxable income limits. Now, a Roth IRA follows similar rules. You'll recognize the $6,500 and the $7,500 limitations, right? That's the max you can put in. But that's about where the similarities end. Because see, with a Roth, you don't get the deduction up front. Then why would you want to use it? The benefits from a Roth come in the future. And that's because of special tax benefits afforded to this type of account. You don't get the pre-tax deduction today. However, so long as your withdrawals are qualified, you'll never have to pay tax on those withdrawals, nor anything that is earned within the Roth IRA. So they can be a particularly good option when someone is expected to be in a higher tax bracket at some point in the future. Now, there are some limitations about contributions to the Roth if your income is what's considered high, and for purposes of this discussion, we've got $153,000 for single filers, $228,000 for married couples, then the Roth IRA contributions are not allowed. So let's talk about how to get around those thresholds, shall we? We can do what's called a backdoor Roth IRA. What we're doing is you make a contribution to a traditional IRA, again, sticking to the limits that are here, $6,500 or $7,500. You make the contribution this year. Now, the next year, you convert it to a Roth. You're not going to get the deduction when your income is higher than these threshold amounts. But see, if your goal is to get into a Roth, you were never going to get the deduction to begin with. So again, the intention here with the Roth IRA is to get the after-tax benefits long into the future. And we'll talk more about the Roth IRA shortly. Now here's the problem with the IRA and the Roth. You can't put that much money in. Remember, the limitations are $6,500 or $7,500. Let's say you're 40 years old and you max it out every year. By the time you're 65 and you grow at a 10% rate, then you'd have $383,000 to live on. I don't know about you, but that doesn't go very far. The 4% rule would let you take out about $15,900 a year to stretch out over your lifetime, and then you'd pay zero taxes going forward if that happened to be coming from a Roth. But still, how long is that actually going to last you? Not that long. So if you're really looking for an opportunity to sock a bunch of money away, much higher than this, then we should probably talk about a different option. I mentioned the backdoor Roth as a way to get around the income limitations with the $6,500 deposit to Roth. But normally, you can't make that contribution because of the income limitations. So if you're looking to sock much more than that away for the future, then you want to look for an alternative type of retirement plan. And that's the best advice I can give you on how to differentiate amongst the different plan types and what's optimal for your client. Let's take a simple IRA, for example. That's going to get you a little bit bigger of a deduction because the limitation in 2023 is $15,500. Now, if you're over the age of 50, you can catch up with an additional $3,500. So there are features within the simple IRA that can make it extremely attractive. Number one is it allows employees and employers to contribute to those traditional IRAs that are set up for employees. So if you're feeling so inclined, you can get a deduction there. One thing you need to be aware of is that anyone earning more than $5,000 would be eligible for that simple IRA. And so it can be a savings incentive match from you to your employees as an incentive to keep them in the business. Now, if you're looking to put away even more, then a SEP IRA might be the way to go. And that's because when we look at the limitation here, it's $66,000, much higher than the simple or the traditional IRA. It tends to be the most popular retirement plan choice, for example, for the self-employed because of this reason. The limitation on the contribution is interesting because the maximum amount is $66,000, but in order to actually contribute that much, you have to qualify. And the way to qualify is you take 25% of your self-employed earnings or $66,000, whichever is less. Now, in the case of an S corporation owner, their W-2 officer's compensation is going to be considered self-employment income, but the distributions will not. So sometimes when we do tax planning to lower payroll taxes for an S corporation owner, we might be limiting the ability on how much they can deposit to a SEP IRA. In this case, for example, let's take someone who makes $100,000 per year. 25% of that is $25,000. And so instead of being able to deduct $66,000, you're limited to just the $25,000. But what's nice is that only the employer contributes, so there's no required matching for the employees, and that means cash savings for the business owner. The employee's always vested in this money, so there's no lose-it rule if you close the business, for example. However, the distributions are subject to tax. So if you have a plan for it to go in and save tax today, you better have a plan for it coming out so it's less taxes in the future. Now, a 401k works a little bit differently. Again, it has a higher limitation of what can be contributed. For example, a 401k with a profit-sharing option still can only deduct $66,000, just like our SEP. But in the 401k, the plan that's designed for self-employed people, for example, is called a solo 401k. And the method of how you can calculate the maximum contribution is different. And this is what could differentiate it for you from the SEP. And that's because when we look at the limitations for the solo 401k, you can deduct up to $22,500 per year plus a catch-up amount of $7,500. Now, the magic is in how that limitation is calculated. You can defer up to 100% of your wage or $22,500 if you're under the age of 50, and you deduct whichever is less. In addition, you can add on a profit-sharing feature that can take you all the way up to $66,000. Now, one of the reasons I really like 401ks as well is because if it suits you, you can actually design in your 401k plan an option for borrowing. In that respect, it gives you a little bit of access to your funds in case of an emergency. Now, finally, as we go up the ladder in choices of retirement plans, we started at $6,500 and now we're up to $66,000 a year for someone who's under the age of 50. But what I'll say is that the granddaddy of them all is what's known as a defined benefit plan. Now, all the plans I've discussed thus far have been what are called defined contribution plans. That means that they are defined by the limit of how much you can contribute today. A defined benefit, on the other hand, we don't really have so much of a limitation on the amount that can go in because we actually define what's going to come out at retirement. So we state a benefit amount that is something we can live on, and we can deduct whatever it costs to finance that benefit in the future. Now, we can state our optimal maximum income of $265,000 per year if we want to, and then an actuary does a calculation to determine how much you're going to have to deposit today to finance that type of benefit throughout your life in retirement. So for that reason, it tends to be the largest tax deductible amount. So if you're really looking for a very large deduction, the defined benefit plan can be a really good solution for that. However, it can be seen as a pro and a con. You're not necessarily locked into how much you are given each year, but you do have an obligation to fund it. So for that reason, you don't really want to set up a defined benefit plan unless you have consistent, stable, disposable income. You can combine this with a 401k so that you get the features of both. But here's the thing, you have to also fairly compensate for your employees. So if you're not feeling so generous, then the defined benefit plan might not be a good option. In fact, a lot of times it poses a cash flow restriction for the business owner because they now have to take on an additional expense. In addition to that, it can be really costly. We tend to see $2,000 plus per year to continue the maintenance on that. And even to modify an existing plan, it can be between $7,000 and $10,000, which can be an expensive option. Now, I'm often asked, what about investing in alternative type investments like smaller companies or crypto, or even private companies or insurance? The solution in that case is what's known as a self-directed IRA. What's unique about the self-directed IRA is it's going to allow you the choice of alternative types of investments. In fact, Peter Thiel, the co-founder of PayPal and early investor in companies like Facebook, has been able to turn a $2,000 Roth IRA into a $5 billion tax-free fortune through his investments in private companies. Now, he accomplished this by taking advantage of the benefits offered by a self-directed Roth IRA. Things like tax-free withdrawals and the ability to invest in a wide range of assets, including private companies, allowed him to do this. And so this demonstrates the potential of a Roth IRA as a tool for wealth building and shows the importance of carefully considering investment strategies and taking advantage of tax benefits. One word of caution, you never want to let the tax tail wag the dog. In other words, leave the investing portion up to your clients while you handle the tax planning. Doing things simply for the value of the tax plan may not turn out to be a wise investment in the end from a financial standpoint. Now, alternative assets, which used to be considered unconventional investments, are now becoming mainstream. There's increasing popularity of real estate investments, for example. There's a search for higher returns and aspiring to grow your wealth. And there's power of technology, and that's all contributed to this shift. The emergence of new digital assets like cryptocurrencies and blockchain has also played a role in that. Additionally, the rise of the gig economy has changed the way people think about earning income and saving, and it offers greater control, choices, and flexibility. So as a result, alternative assets are no longer seen as an alternative, but as a viable option for investment and wealth creation. Now let's talk about required minimum distributions, or RMDs. This is the end point, and now your income becomes taxable when withdrawn from the retirement account. The new rules say that once you reach the age of 72, you must take required minimum distributions from your taxable IRAs, except Roth IRAs, and generally from your defined contribution plans. If you don't comply, you actually can owe a penalty equal to 50% of the amount you should have withdrawn but didn't. You can avoid the RMD rule for a non-IRA Roth plan by rolling these funds into a Roth IRA. Just know that when you make that rollover, it's called a taxable conversion. So you pay tax on whatever amount you convert to Roth. So should you choose to take distributions between ages 59 and 72, for example, or take more with the RMD after age 72, waiting to take distributions until age 72 generally can be advantageous. But a distribution or larger distribution in a year your tax bracket is low is gonna result in you paying less tax. So remember the importance of planning on the back end as well. Before you make a distribution, consider the lost future tax-deferred growth and, if applicable, whether the distribution could cause your Social Security payments to become taxable or increase your income-based Medicare premiums and prescription drug charges. The third effect you want to consider is how it interacts with other tax breaks that have income-based limitations. You also want to keep in mind that while retirement plan distributions aren't subject to the additional NII tax or the additional 0.9% Medicare tax, they are included in your modified adjusted gross income. That means they could trigger or increase net investment income taxes on other investment income that you have. And that's because the thresholds for that tax are based on your modified adjusted gross income. Now, if you've inherited a retirement plan, make sure that you follow the new 10-year stretch IRA rules with a plan to withdraw that money in a tax-friendly way, because the rules have changed. In late 2022, Congress passed legislation that raised the age you have to start taking your required minimum distributions. It's going to go from 72 to 73 years old, starting in 2023. And that means that if you turned 72 in 2022, you'll need to take your first required minimum distribution by April 1st of 2023, and you're going to need to take another one by the end of 2023. Now, if you're turning 72 in 2023, you won't have to take an RMD until the following year when you turn 73. And of course, that will be due April 1st of 2025. Now, although profit sharing plans and SEPs are pretty similar, there are different rules that apply to each that could affect how much you can contribute. For example, only a profit sharing plan allows you to include a 401k arrangement paired with it, which, depending on your income and age, might allow you to contribute more. When you change jobs or retire, avoid taking a lump sum distribution from your employer's retirement plan because the funds will generally be taxable and potentially subject to that 10% early withdrawal penalty. Now, you do have options that will help you avoid current income tax and penalties. For example, you can simply stay put. In other words, you may be able to leave your money in your old plan. But if you're going to be participating in a new employer's plan, or you already have an IRA, this may not be the best option. Why? Because keeping track of multiple plans can make managing your retirement assets more difficult. Also, consider how well the old plan's investment options meet your needs. When you're changing jobs, another option is to do a direct rollover to your new employer's plan. And this may be a good solution because it may leave you with only one retirement plan to keep track of. But also consider the new plan's investment options. And finally, the last option is to roll over those funds to an IRA. It could be a brand new one. If you participate in a new employer's plan, this will require keeping track of two plans. But it may be a better alternative because IRAs offer nearly unlimited investment choices. Now, if you choose a rollover, request a direct rollover from your old plan to your new plan or IRA. Otherwise, you're going to need to make an indirect rollover within 60 days to avoid tax and potential penalties. But you should also be aware that if you don't do a direct rollover, the check that you receive from your old plan may be net of 20% for federal withholding. And if you don't roll over the gross amount because that 20% has been withheld, you'll be subject to income tax and potentially the 10% early withdrawal penalty on that withholding. That's like a double whammy. So just do that direct rollover and you'll avoid all of that. I hope this helps give you some ideas on how to share this with your clients and select the optimal retirement plan working together with them, because that's what's going to get them eager about working with you to save tax. If you want some more ideas on advanced tax reduction and how to incorporate tax advisory services in your business, check out the website on the next slide.